Hey guys, it is December 19th, 2018, and the Fed has met and they have increased interest rates by 25 basis points. That's 0.25%. That is totally expected and barely newsworthy. I want to let you guys know that's already baked in the cake. That's what they were expected to do. Now, what I believe is that they're doing that, one, to control inflation, which honestly is already in control, but two, to set up for a potential recession that could be coming. We got 4 good reasons why we think it's coming. Before we get bogged down in the details of interest rates and all that economic news, here's some interesting stats from home builders. In November, housing starts were actually down 40,000. Guys, that's kind of something we probably already knew this time of year. We get it, seasonal. Not a lot of houses are being bought and sold, but housing starts for new construction, it's not a good sign. That's for the next spring or next summer. The permits being pulled were relatively flat. The National Association of Home Builders actually surveyed their home builders, and their index came back at a 56. This is down from being around 60, 61, and that's down from being at a high closer to the mid-70s. The good news, anything over 50 is actually positive. It means growth. But to the point, home builders themselves, they're seeing the slowdown. They don't know that it's going to be quite as rapid as we've once thought. So for 2019, plan on that. Sales volume is down right now, but that's to be expected. It's seasonal. Very few people want to buy and sell during Thanksgiving, Christmas, and all the holiday fun. That said, we do think, and the market's projecting to do less business in 2019. And you can argue some of that could be affordability. Here in the Dallas-Fort Worth area, we know that homes have appreciated 50% over the last 6 years. And considering interest rates are up about 3/4 to a full percentage point more than they were last year, that just makes it expensive. And that absolutely is a real reason. Another could just be buyer fatigue. You had so many people that did buy or already bought, the ones that are out there maybe gave up. They're now renting and giving that up. I think the real answer, guys, could also be that buyers are worried. There's a lot of news out there and headlines, and when stocks have been as volatile as they have been lately, you know, that's tied to most Americans' direct net worth, whether it's a 401k or stocks or money in the market. That volatility and that loss of quote assets could certainly have a psyche or impact the psyche and have an adverse effect on financing. Here's an interesting stat, guys. I didn't even know they tracked this, but did you know disposable income is literally 700% times the net worth of Americans? I mean, it's literally, it is the highest it's been in many, many years. To put that in perspective, in the mid-90s, right before the recession, that number was 649%. Again, I don't know where these numbers come from. Well, I know where they come from, but I don't know how they track them. But guys, that is oftentimes a lead indicator of recession. And did you know that pay rates have actually increased? The average American is now making a little bit year over year, 3% higher than what they were the year before. That's awesome. But you know what the catch is? Americans are actually taking home less money. How is that? They're getting less hours. It's getting more and more expensive for employers to hire people because the workforce is less at 3.7% unemployment, and they're having to cut back on hours. So guys, guess what? A little bit of disruption in the economy. The biggest overhead for a company, people. Unfortunately, that could mean, again, layoffs and things like that, and all of a sudden, you know, a business can't sell to somebody who doesn't have an income coming in. It could mean trouble. The last canary in the coal mine, while we think a recession could be semi-imminent, meaning in the next 12 months, give or take, could be the inverted yield curve. It's a fancy way of saying that long-term rates or investments end up costing about the same as the short-term. So look at this graph of the 10-year bond and a 10-year and a 2-year, 10-year treasury and 2-year bond. The rates end up almost paying out the same. So when the Fed increases interest rates, that absolutely directs short-term financing. Long-term financing, like the 10-year, ends up being more inflation-based. An inflation rate is a 2.1, 2.2 core inflation rate, depending on what you look at. But honestly, again, guys, that inverted yield curve, check out the graph. Every time it hits that near zero mark, ends up being a recession shortly thereafter. Guys, what do you do with that information? Ultimately, just share it. Let people know that, again, right now might be a great opportunity to buy. If the market has slowed down, which it has in most markets, but appreciation still exists, and it does, now might be that opportune time where they can go out and buy the home they looked at this summer for maybe a lower price. The sellers may be willing to make a deal. Maybe they've been sitting on that home with another home already purchased. Maybe they're waiting to move or do something, downsize. So now's a great time to buy. Knowing the recession's coming, just plan accordingly, guys. For all those self-employed or all those that are very market-driven based on volatility, save the shekels, do what you need to do, and make sure you're prepped for it. But guys, if you have any questions about this or anything else, we're here to help. As always, we appreciate you, and Merry Christmas and Happy Holidays.